This is Mark Rosser from Learn Bonds. Bill Gross is one of my personal heroes. He's an investing legend, and I was really pleased to discover that he provides free monthly advice on his thinking.
The PIMCO Total Return Fund has been managed by Bill Gross since its inception. What if you could privately ask Bill Gross what he thinks of the market? What if he told you in broad strokes what he planned to do? Would you be interested? Once per month, PIMCO shares its strategy with investors in its monthly commentary. Here are our takeaways from the most recent monthly commentary. What you see on the screen now was directly taken from the Treasury and Rates section of the monthly commentary. Here are the key points. The Fed is keeping the Fed funds rate, which determines short-term interest rates, very, very low. The Fed has also been buying longer-dated treasuries, pushing down yields for 20 and 30-year treasuries. The only place where the Fed has not been directly acting to keep down rates is in the middle of the yield curve, securities with 7 to 15-year maturities. That's where PIMCO is buying. PIMCO implies that if rates remain low for shorter maturities, that they may sell these more intermediate-term securities for a profit as they approach the shorter end of the yield curve. What you see on the screen now is directly taken from the corporate bond discussion of the report. What's the key takeaway? An improving U.S. economy is good for financial companies. There will be lower default rates and more demand for borrowing. Financial bonds did worse than other sectors last year, and PIMCO sees a potential rebound. What you see now is taken from the MBS section of the report. What's the key takeaway? Fair value implies PIMCO sees limited room for price appreciation. In other words, if you buy these, you probably will be holding them to maturity. Most MBSs have an explicit or implicit government guarantee, but yield more than treasuries. What you're looking at now was taken from the municipal bond section. The key point is that implicitly, PIMCO is saying avoid general obligation bonds and don't buy riskier and therefore higher yielding muni bonds because the little return, additional return, won't be worth it. What you're looking at now is taken from the tip section. What's the key takeaway? The 5 and 10-year tip actually have a negative yield. In order to make money, an investor would need there to be inflation. The 20 and 30-year pay a little bit of yield. PIMCO is saying that they're not interested in buying security where you need there to be inflation to make money. And that's your $200 billion worth of bond advice for February. Check back in a few weeks for our March report, and for more great bond commentary, visit learnbonds.com.